Hey, welcome everybody to the 40 Finance channel. Today I'm talking about the SCHD ETF. This is a wildly popular dividend ETF that is all over YouTube. It's all over social media. And, a lot of people touting this one as a way to retire, as a way to replace their job, is some of the headlines that I've seen. So I thought we'd dig into it a little bit and I just share my thoughts on it. Officially, it is the Schwab US Dividend Equity ETF. And I'm going to look at this one from a couple different vantage points, and we're going to use Seeking Alpha. By the way, if you're interested in learning more about Seeking Alpha, which is a platform I use all the time on my channel, check out the link below for a free 7-day trial as well as $30 off your first year. And kicking things off, I think one of the most attractive features for this one, particularly with like a social media type crowd, is of course the price. $25 is affordable for a lot of people. It would not be hard to skip a couple nights out at dinner and buy a 1 or 2 or 3 shares of SCHD. And I think that that's an obvious reason why this one has picked up so much momentum is the price point and everybody can participate. And the consistency of the price today is at $25. But if you look back, all the way back into May or June of 2021, it was about $25 back then too, and that's of course because it pays out such a high rate of dividends. I'm going to zoom in on this. If we look over here, the trailing 12-month actual yield was 4.09%. That worked out to be $1.04. And if you're tracking at home, remember that this is trailing 12 months. So 12 months ago, it's not the annual payout. 12 months ago, of course, would have been April of 2024. But the biggest thing that this one offers is the actual dividend growth. And when I say growth, it's actually different than the yield growth. So you can see, yield being like a percentage. You can see how the yield has been, relatively consistent. It's got a bump up here, but it's the payout growth, which is probably the most important thing. So you see here in 2020, the annual dividend was about 68 cents, and last year it had risen to 99 cents. So even though the price of the shares hasn't really changed a whole lot over time, the actual money that you got as a dividend did go up. And if you can see through on the table view, I think is easier to look at myself, but the year-end yield is kind of been up and down. So if we just go back to 2021, the year-end yield was 313. Then it went 368, 365, 367. Not a huge change there, but the actual payout amount, they've been able to deliver gains on that front. So just like we saw in the other bar chart, 99 cents in 2024. If you go back to 2014, then it was 35 cents. So the way they've engineered this thing, the goal is to pay out more every year. Now, the other thing that you'll hear a lot of folks talk about, which is also a smart strategy, is just the alternative to the Mag 7, alternative to big tech. And the holdings that SCHD has are, significantly different than like a QQQ. You got Coca-Cola right at the top, Lockheed Martin, ConocoPhillips. There is some tech in here. I went over to the main website, and there are some tech names. I mean, Verizon, for starters, might as well be a tech name. You got Cisco, Texas Instruments, and probably a couple others if we went through all 100 stocks. But to be fair, if you're looking for a tech alternative in the dividend space, they've done a really good job of the names that they've put together of avoiding that. It's probably unlikely that, let's just say, NVIDIA is tied in any way to Coca-Cola in terms of stock performance. That being said, it's important to note that, when NVIDIA crashes, or let's just say the Mag 7 in general crashes, you can pretty much expect all of the stock market to crash. I think it would be rare. In my opinion, it would be very rare for Mag 7 to go down substantially on a news event that did not impact Coca-Cola, Lockheed Martin, things like that. All right, so I said SCHD is popular in social media land, and I got to say, one of the things that is odd to me is how people price watch this dividend ETF. So obviously, we've had some market turbulence, and you've got people 2 days ago saying, why is SCHD crashing, dropping like a rock, SCH down 8%, and, warning signs and all this stuff. I mean, this is a dividend ETF, first of all. Second of all, the price of this one, as I've already stated, has not really changed much. It's simply not the goal of the fund for this number, $25, to, let's just say, go to $100. It hasn't done it over the past 4 or 5 years, and I don't think it's going to do that to, say, hit $100 anytime over the next 4 and 5 years. The goal is to pay out the gains that the stock is making. So when you see people talk about the actual price of this one, assuming it doesn't go to like $2 or something, there's not a whole lot of reason for you to be super upset. And this crash, so to speak, that was on the videos I was looking at, this crash went from December 5th's high of $28.95 to this low point in April of $25. So this crash stuff, warning signs, dropping like a rock, I'd have to say those people are probably in it for the wrong reasons, and they need to re-examine exactly why they're invested in SCHD. All right, the next thing I just want to call out on SCHD, like I said, I have no problem with the fact that it is an affordable per share ETF to invest in. $25 makes a ton of sense. But I think that everyone should know that it's not necessarily the best choice. But in the interest of the time, I tried to pick 5 different funds here just to give us something to compare to. SCHD, QQQ, of course, because that's what I talk about the most on this channel. The Dow, which is, of course, a totally different mix than QQQ, and it also has some heavy dividend players. The Vanguard Dividend Appreciation Index, so the VIG. Some would say that is a competitor to SCHD in its own way. And then VYM, which is Vanguard High Dividend Yield Index Fund. Again, I would put this in the same category as a competitor, if you will, to SCHD. People who choose one or the other could have a lot of reasons for doing it. There is no necessarily one size fits all. And that's why I would be hesitant to sort of rip SCHD, because I think it has its little niche of being attractive for the price point and for the fact that the payout does seem to grow every single year. But if we're just going to get down to the brass tacks and look at things, I want to call out that the most important thing to look at when you're comparing dividend funds in particular is the concept of total return. So total return, obviously incorporates the price of the stock. Has it gone up? Has it gone down? But it also incorporates the dividends that were paid, assuming they were reinvested during the time frame that you're studying. So if we look at, let's just go for 3 years. If we look at the 3-year total return, SCHD is 8.36%. QQQ, totally different stock. You could even make the argument that QQQ plus SCHD might be to some a well-rounded portfolio. So we know that the Qs went up much more than a dividend one. That's not a big surprise. The Dow, 20%, VIG, 22%, and VYM, 18%. So if we just say VIG and VYM are very similar to SCHD in some ways, you've got 2 right here that have essentially outperformed SCHD by double or more. Now, what if we go a smaller timeline? We can say year to date, it's been a tough year in the market, right? A lot of things have went down. SCHD -6, QQQ -13. Dow's down -7, VIG's down -5.6, and VYM is down -4.67. So again, these two are beating SCHD. Everybody's down, everybody's losing, but the VIG and in particular VYM are losing less. And it looks like on the 5-year, it is neck and neck with VYM on, comparing dividend ETFs. So neck and neck right there. And I believe these guys have the exact same expense ratio. Yes, they do. But you can see also that if you just own the QQQ for 5 years, you would have substantially outperformed everything else on this board. I get it. Nobody should be all in on any one thing. But I'm just pointing out that generally speaking, if you're investing over a 5-year time horizon, it's going to be growth stocks, in my opinion, that are going to win every time, particularly across 5 years. You may get some bad luck that when you buy, the exact times that you buy are the worst times to buy, but that's pretty unlikely if you buy and hold almost for anything in the stock market. And the most important thing that I think I want to call out today in terms of SCHD and any other type of dividend fund is we get in this market volatility. And a lot of people get scared, understandably. Nobody wants to lose money. And if you're not careful, you're going to be inclined to, sell all your growth and go hide in dividends until, tariffs go away, until there's a new president or whatever it is that's concerning you. And what's going to happen in that scenario is undoubtedly you're going to miss the best 10 days of the market for each year you do that. And the best 10 days, this comes from FundStrat's Tom Lee. And in regards to the best 10 days, he's got a quote here. As he reminded us last week, buy and hold strategies tend to outperform, citing the rule of 10 best days. The stock market makes the most of its gains in the 10 best trading days of any given year. Since 1928, S&P has averaged annual returns of 8%, but if you missed the returns generated on the 10 best days of each year, those returns transform into an average annual decline of 13%. So long story short, and we'll just trust Tom on the statistics, if you miss the 10 best days of any stock market year, you are at a substantial disadvantage. So if you are looking at, let's just say NVIDIA, if you're looking at NVIDIA now, or QQQ, whatever, and you're like, this one's down, I'm getting out, well, it's been a tough overall year for stocks. So if you leave now, you are very likely to miss the 10 best days of the market. Could be we've already had them, just to be fair. It could be that. But to me, I think the probability of that is pretty low, that we've had all 10 best days here through April 18th or so. If you sell out and move everything to dividends, you're essentially not buying and holding anymore. You're trying to time the market. You're going to miss out on good things. And those good things could include big days for SCHD. But obviously, if you miss the big days in the QQQ, you are going to be kicking yourself down the road. All right, guys, so that's a quick look at SCHD from my vantage point. Again, for a $25 dividend ETF that a lot of people can afford and get into, well, there's a lot worse things out there than buying SCHD for the rest of your life. Just know that as much publicity as it gets might be a little overbearing on the actual performance when you break it down and you think about things like, what am I missing by putting my money in here? Just make sure you balance out everything. Before you go, don't forget to check out that special offer for Seeking Alpha down below. I hope everybody's doing well. We'll see you on the next video.